Okay, good day, everyone. Today is Saturday, 22nd of May, 2021, where we'll be discussing on the concluding phase of the consolidated statement of profit or loss and other comprehensive income. This surveys consolidated statement of changes in equity. Now, today we'll be looking at, which is more or less like a part 3 of the discussion. We'll be wrapping it up with 1, issues that borders on the treatment of unwinding of discount that is inherent in either deferred consideration or contingent consideration arising from the acquisition of a business in a business combination. And lastly, we'll look at treatment of preference dividend in consolidated statement of profit or loss, and also in the consolidated statement of changes in equity. Okay, and at that point, we'll put it to an end, the discussion on consolidated statement of profit or loss and other comprehensive income. Now, to start our discussion today, we are going to more or less harness this resource question on unwinding of discounts. Unwinding of discounts is tantamount to you trying to recognize finance costs in the process of accounting for the financial performance of the group. And in that light, we make use of this question as a scenario question towards appreciating our discussion at this level. Okay, I want somebody to read this question, if you can see it clearly. Let me enlarge it more. I want somebody to read it.
Okay. Unwinding of discount on deferred / contingent consideration. Illustration 21. Arsenal acquired 80% interest in the equity of Chelsea as of January 1, 2016. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended 31st December 2016. Revenue for Arsenal 600 million naira, Chelsea 390 million naira. Cost of sale 345 million naira for Arsenal, 201 million naira for Chelsea. Gross profit is 255 million naira for Arsenal, 189 million naira for Chelsea. Distribution cost is 75 million for Arsenal and 45 million for Chelsea. Administrative expenses is 105 million for Arsenal and 90 million for Chelsea. Profits before tax is 75 million for Arsenal and 54 million for Chelsea. Income tax expense is 25 million for Arsenal and 29 million for Chelsea. Profit for the year is 50 million for Arsenal and 25 million for Chelsea. Movement in reserves. Retained profits brought forward is 120 million for Arsenal and 20 million for Chelsea. Profit for the year is 50 million for Arsenal and 25 million for Chelsea. Retained profit carried forward is 170 million for Arsenal and 45 million for Chelsea. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira. And the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. As an acquisition, the parent in addition to the share, as an acquisition, the parent in addition to the shares consideration, that is share exchange, offered to former shareholders of the subsidiary a cash payment of 28.8 million naira is due to be paid on 31st December 2017 to the shareholders who sold their stakes in the parent. The odd rate or cost of capital of ASNA is 20%. In this context of this text, we will approach a step-by-step approach to explaining the requirements of IFRS 10 with regards to consolidating the financial results of the parent and the subsidiary as depicted below. ASNA Group.
No, that's all.
Sorry.
Thank you very much. Thank you very much. Thank you very much. What we're going to do now is to more or less use our model templates we have created to attempt solving this question. Okay, I switch to our model template now. Now, these are model templates where we have the same question. Okay, what has changed in the question? Let's see the information given to us. This seems to be the same, all true. Okay. Now, the only information that is new here borders on this. If I could highlight it. As at acquisition, the parent, in addition to the shares consideration offered to former shareholders of the subsidiary, a cash payment of 28.8 million is due to be paid on 31st of December 2017. Okay. Who's to the shareholders who sold their stake to the parent. The odd rate, or what we know as cost of capital of ASNA, is 20%. That's the only information new here. And what that information presupposes is what we tend to solve at this point. Okay. Okay. Now, what then do we need to do? Is to recognize the fact on the following, that acquisition, date of acquisition was 1st of January. Was 1st of January 2016. And we are reporting on 31st of December 2016. That is 1 year apart. Now, there was deferred consideration with a future value of 28.8 million naira payable in a year time. Therefore, what do you have to do to this? What we have to do to this is to discount it. With the cost of capital back to 1st of January 2016, which means a year backward. Now, what then do we do? I'll come here and say, I need to obtain first the present value of the deferred cash consideration as at date of acquisition. When is our date of acquisition? 1st of January 2016. Now, what is my future value? My future value in thousands of naira is 28.8 million. That's my future value. Now, my discount rate is my cost of capital, which is 20%. Okay. Now, what is my present value? My present value is for me to discount it back 1 year. 1 year is this 28.8 multiplied by 1 plus 20%, all of it raised to power minus 1. Okay, because I'm discounting it back 1 year. Now, how do I do that? Is 28 multiplied by 1 plus R. What is my R? 20%. All of that raised to power minus 1. I close all of these brackets. And this is what we get. The same way you'll have used your calculator to derive that. Okay. Now, can we change that question to 10%? 20% seems to be high. Let me change it to 10%. Let me change it to 10%. Okay, and this is 2 years. It's going to be settled in 2 years' time, not a year. Look at the date here. The difference between 31st December 2017 and date of acquisition, 1st of January 2016, is 2 years. Therefore, it's going to be payable in 2 years' time. In 2 years' time. Therefore, I'll change this to 2. Now, use your calculator to confirm what we have. Okay, wait. Let me still leave it at 20%. It might not be high. Now, using my calculator, I still get the same amount, which is 20,000. You can confirm from your own side what you got.
It's correct, sir. I've confirmed.
Okay, it's correct. Okay. Now, 20,000 is the value as at today, which is the date of acquisition. Now, and that will have gone into our measurement of, goodwill. Now, what do we need to do now? In year 1, which is 2016, we need to recognize finance costs for the year, which is a process of unwinding of discounts in the deferred cash consideration. Now, how do you recognize that? It's for me to find the interest, which is equivalent to the cost of capital, which is 20%, multiplied by the present value of the deferred cash consideration as at beginning of the year, which is 1st of January 2016. And you are doing that for 12 months. Remember, $12 months, because the year runs full year. From date of acquisition to the end of this year was exactly 12. Therefore, it means the whole 12 months is what you are going to recognize. And how much is it? It's for me to find the interest, which is the product of the discount rate multiplied by the present value, which is 20,000. And that is 4,000. What we have just done is 20% of the 20 million. That's what we have done here. Okay. Okay, that's what we've done. Therefore, what entry are we going to pass here? This finance cost is only of the parent. Therefore, the accounting is to show a reduction in the profit of the parent. Therefore, what do? We debit the group profit, which invariably reduces the retained earnings and credit to deferred cash consideration, which is a component of liability. And it is current if it is 12 months to the end of the period, and it is not current if it's still more than 12 months to the end of the period. How much is that? The 4 million. That is the entry we are passing here. Now, how does that affect profit or loss since you are not treating balance sheets? Is that we now have a line that we have created for profit or what? Or loss, which means this is before interest and taxes. Therefore, we have our interest, finance cost. We now have our profits before taxes. Therefore, what's our finance cost? There's none from the question, but our adjustment says our finance cost will increase as a result of this 4 million. Therefore, that triggers the 4 that we are now deducting. And this is the only adjustment that we have. And therefore, okay. Okay, that's that. Now, the adjustment we have only passed here is to recognize finance cost. Okay, and this finance cost comes here as an adjustment which is unwinding of discounts. I call it finance what? Cost or finance charge. And this amount is going to bring about reduction in the profits of the parent. Why? Because it's the parent that has that obligation in his book. And therefore, what do? We recognize the whole of these four. From this angle here, it affects the parent. We are not sharing it with NCI. Now, the profits of the subsidiary will be shared between the parent and NCI in the proportion we share profit or loss. If you have been following us, and that's why we are sharing this 25, 20 comes to the parent, and the 5 goes to the NCI. Invariably, this is a reduction in profit, and we can now sum everything together. To obtain what we are going to report. In our profit or loss. Okay. Now we can now come back to our normal accounts. The only thing missing here is that we don't have finance costs. Therefore, we bring it in. The same thing we have here. This side is our workings. This side is our normal solution. Therefore, I bring this in. And therefore, I can link all of my sheets together. Therefore, we've produced our consolidated statement of profit or loss and other comprehensive income. Now, those expenses, finance costs and taxes produced profit of 71 million, which is attributable to owners of equity, 66, and non-controlling interest, 5. And this came from what we've done here. Okay, now let's check other information that were first statement of changes in equity. The pre-acquisition retained earnings was it given to us? On this, they bought strictly, okay? Pre-acquisition retained earnings was 20. Remember, we acquired this at the beginning of the year. Therefore, pre-acquisition retained earnings was 20, which means that subsidiaries retained earnings buffer will be 0 because not a subsidiary as at prior date. And this is not a subsidiary as at end of last year. When was last year? 31st December 2015. Because as at the beginning of the year when we acquired, all of the reserves are entirely pre, and therefore there's no post-acquisition element in it. Let's take note of that. Parent retained earnings brought forward is 120. Non-controlling interest is 24. Therefore, all other information remain what? The same. Okay. And that is what we add there. And this 66 and 5 flew from here to here. And remember, 120 is from this adjustment we had there. And since there's no post-acquisition element in the retained earnings brought forward for the parent in the subsidiary, therefore this is the 0. Okay, and likewise this. And that's what we've seen here. Okay. What other question do we have? What other question do we have? Any question? Now, the only adjustment we have made there that is new to what we've done before is the finance cost. And the finance costs affect the parent alone and is attributable to the fact that the parent has an obligation with respect to deferred cash consideration. And that is what you are seeing here. Any other question? If there's none, we'll look at questions that more or less relate to deferred consideration from prior years. What will have happened if the deferred consideration is not just something that started this year, but it's a deferred consideration that occurred prior year, in which in the prior year, you will have unwound part of the finance cost, and this year you're unwinding other part of the finance cost. Now, on that premise, I'll more or less copy this illustrative question to explain that to us. (22). Okay. I want somebody to read this question. Similar to what we just done, but you see the difference in a couple of minutes.
Okay. Illustration 22. Asna acquired 80% interest in the equity of Chelsea as at January 1st, 2015, when the retained earnings stood at 20 million naira. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statements of the subsidiary without of the parent as at December 31st, 2016. Income statement for the year ended 31st December 2016 for Arsenal and Chelsea. Revenue 600 million naira. For Chelsea, 390 million naira. Cost of sales for Arsenal, 345 million. Chelsea, 201 million. Gross profit for Arsenal, 255 million. Chelsea, 189 million. Distribution cost, 75 million for Arsenal, 45 million for Chelsea. Administrative expenses, 105 million for Arsenal, 90 million for Chelsea. Profits on before tax, 75 million for Arsenal, 54 million for Chelsea. Income tax, 25 million for Arsenal, 29 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Movement in reserves. Retained profit brought forward, 120 million for Arsenal, 65 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Retained profit carried forward, 170 million for Arsenal and 90 million for Chelsea. Required. Prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira. And the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. As at acquisition, the parent, in addition to the share consideration, that is share exchange, offered to former shareholders of the subsidiary a cash payment of 28.8 million naira, is due to be paid on 31st December 2016 to the shareholders who sold their stakes to the parents. The order rate, that is cost of capital of Arsenal, is 20%.
Thank you very much. Now, who can tell me the difference between this question and the first question? What's the difference? Who can tell me the difference? Shakun, can I hear you? I think you're muted. Are you trying to say something?
Just trying to look at it.
Okay. And? Nuruddin? And any question, any contribution?
No, sir.
Nuruddin?
I just joined. I don't.
Okay.
Okay, I think the only
We can't hear you. You are muted. You are muted. Hello? Nuruddin, you are muted.
Okay. Okay, what I'm saying is that the only difference I observe in this question and the previous one solved is that the discount that we are going to unwind will be for just period of 1 year. Meaning that the discount that will be unwind will be for the period we are carrying out the financial statements.
Yeah, we also did 1 year in the last one now, because you are dealing with profit or loss. You only account for your finance costs for that year.
Okay, let me just add to it, to what he said. Okay, considering the date when the subsidiary was acquired, this was 1st of January 2015.
Look at this date.
Okay, and that means that as at 31st December 2015, one financial year had elapsed.
Has elapsed. Now we are in the second. This is the second year.
We must have recognized finance costs unwound 1 year for that financial year. So the next financial year, which is as at 31st December 2016, So we are going to carry out the unwinding of the final lap
Because
of
the entire
finance
payment
costs.
is due on these dates.
Yes.
And this is the second year of the whole year. Okay. That's nice. That's nice. Now, what happened is that since you don't know what our present value was as at beginning of as at 1st of January 2016, what we know based on this present value was date of acquisition, which is 2015 now. Remember, the date of acquisition has changed. It then means that this first winding is for last year, 2015. And therefore, for 2015 is year one, which means what I've done here is only for 2015. What then will I do? I have to do for 2016, which means my present value as at the end of 2016, that is the present value of the deferred cash consideration as at 31st December 2015, which is the same as 1st of January 2016, is equal to what? Is equal to the balance brought forward in 2015 is equal to the balance as at 1st of January 2015, which was the date of acquisition. How much was that? 20 plus the finance cost record 12 months period. And how much was that? This 4 million, which means net, the present value now is 24 million. This 24 million alternatively can be obtained as follows. And I'll refer you back to the video we did then. Can be obtained as the compounding of the present value of the deferred consideration as at 1st of January 2015, which was the date of acquisition, by the cost of capital, which is the discount rate, as thus. How do we do that? The present value, which is 20 million, or figure in thousands, multiplied by 1 plus R. What is our R? 20% cost of capital raised to power 1. Therefore, and that produces what? 20 million multiplied by 1 plus R What's our R? 20%. Everything raised to power 1. That's 24 million. And again, alternatively, you can equally obtain it. And the reason why I'm showing you this alternative is because information might not be readily available the way you are used to. Therefore, you use your knowledge of the principle to always narrow your way, which means in this case, I can find the discounting of the future value of DCC as at the due date. The due date is 2016 December, when it will be paid, back to 1st of January 2016, which is a year backward. I am going to do that by the cost of capital. Now, what do you do? If it's discounting, it is now that discounting by 1 period backward. Therefore, it's raised to power. Okay, I didn't do this power before. Discounting is now negative. Now, in that case, what do you do? The present value is 28 million multiplied by 1 plus R raised to power -1. And that will give me how much again? It's still going to give me 24. Which means regardless of the way I treat it, it's still going to give me the same thing. Now, that is that. Now, this one is a prior year item that will have affected retained earnings as at the beginning of the year, which means the retained earnings affected will be as at 31st December 2015, which is also equivalent to the beginning of the year. Take note of that. Okay, now the current year is what we are now interested in, which is year 2. Year 2 now is what I needed. In year 2, which is 2016, the same thing we are going to do, but it's now present value as at 2016, which is also a whole year. And present value as 2016 is no longer 20, but 24. Therefore, what do? I multiply my discount rate of 20% by 24. Any of these 24 is what you pick, as the case may be. And that gives me 4.8 million. Now, if you add 4.8 million to 24, it will take you back to this 28.8 million, which means you have successfully unwound all of the discounts. And this goes to our retained what? Earnings as at 20.60. And that is it. Which means the current year now, since we are doing 2016, the current year will only be affected by 4.8, not 4 million. 4 million was for last year, 2015, while 2016 is 4.8. And the whole of that 4.8 affects the parent. Cost is the borrowing of the parent. NCI is not what? Affected in that regard. And that is that in that case. Now, what now happened is that retained earnings brought forward is 65, which means what we said earlier does not affect this. We are now back to our normal value because the acquisition was for last year, and therefore there's no problem about our retained earnings. And our result as at acquisition, okay, and that is this 20 million here. And NCI was fair valued as at acquisition what date? That's where I got the 24 million from. And therefore, we'll come back here. What is our 80%? 80% of our post-acquisition brought forward, which is made up of balance brought forward minus pre-acquisition retained earnings. 80% of that is 36. Now 20% of it is what we now take to NCI. Therefore, I'll change 80% to 20%. And that is 9. Okay. This is of that. Now, any question on this? Now, what now happened is that our retained earnings of the parent will further be affected by last year's let me shift this down. Well, now, this will be affected by our previous year unwinding of discounts, which is finance costs, aggregate finance costs for prior years. Prior years means that because retained earnings is a balance sheet item with cumulative balances, if we have had finance costs last year for unwinding of discounts, we add that, we deduct that from it. If it's for 2 years, we deduct. If it's for 3 years back, we deduct. Because retained earnings is a cumulative effect of deduction that has happened over years. Okay, and we deduct that. And that is why I made reference here to where we'll be picking it from. Remember, there was a reference I made here that you are deducting this against your retained earnings as at 31st December 2015, this 4. Okay? Therefore, in that case, you sum this up. This will be 152. This will be 33. And there's no added on acquisition because that has occurred before now. And therefore, this is nil. Any other question? Any question there?
Yeah.
Now see what our result is.
So I have a question, sir.
Yes.
So I just want to know why we use a cost of capital for unwinding the discounts. For instance, since what actually impacts time value of money is inflation, and this is not like a real borrowing or something. So why don't we use the inflation rate rather than the company's cost of capital?
Okay, I think we discussed the principle of time value of money at the inception when we are discussing deferred and contingent consideration. What does time value of money covers for? Who can remind us what we said time value of money covers for? What is time value of money trying to capture that make us to reach a conclusion to say 1 naira today is not the same thing as 1 naira tomorrow? Why did you reach that conclusion?
Okay. I think what we discussed then was that before we arrive at company cost of capital, we've factors all the indicators like interest rates or exchange rates and all other indicators that can affect the investments, which make the company.
Okay. Now, cost of capital is synonymous to the opportunity cost, which is alternative forgone if that money has been used for other purposes. Now, cost of capital is to more or less take care of the following. One is to take care of the loss of power, is to cover for the opportunity cost of tying down capital, which will have invested to earn a return. And every other market indices that has a role to play. And that's why we say cost of capital is the minimum rate of return that is expected by an investor to earn over a period of time, usually a year. Are you getting what I'm saying now? And that is it, which means cost of capital is not inflation only, it covers for every other thing. Now, I'll give you a practical example. Let's look at economy that have stable prices, market prices or any other prices, where inflation seems to be very low or insignificant, but there's still effects of time value of money, or because it also captures opportunity costs, which is the alternative venture to which you can earn return rather than tying down your money somewhere else. You get what I'm saying?
Yes, sir.
Yeah. Even in a period of deflation, if any, time value of money is still taken as a factor. Why? It then speaks to the fact that it's not about inflation. This question you asked is also synonymous to erroneous belief or misconception about depreciation, where people will tell you that you don't depreciate land because it is appreciative in value. But the question is, that is not correct, because we have some other categories of assets that you continue to depreciate even when in the midst of it having higher value, which you revalue them and you are depreciating them. How come you are doing that? Which means depreciation in that regard is just a medium for allocating the cost already incurred over a determinable number of years to which you believe you can draw benefits from that use of assets. But for land, mostly, except in jurisdiction where land is under lease, you'll find out that land, by their nature, because it's freehold, you'll find it difficult to predetermine when the whole value of that land will be eroded, how long that land can last. You can say it will last 1,000 years and it lasts millions of years. You can say it will last 10 years and it doesn't last more than 5 years because erosion and some other things take off the land. Do you get what I'm saying now? And that is just it. I believe that has simplified it for you.
Yes, sir.
Okay, thank you very much. Now, this is a position. Any other question? Any other question? Any other question? Okay, in the absence of no question, now let's move to the last phase of it, which is preference shares, or where we have situation, we have preference dividend. I need a volunteer to assist us. Yeah. Volunteer? Who volunteer?
Let me read it.
Okay.
So, treatment of preference shares, 12th principle. In this scenario, we will consider the basic treatment of preference dividend on preference shares recognized as an equity instrument in line with IAS 32 and its effect in the attribution of profits to non-controlling interest for the reporting period. The share of the NCI where there is no preference share within the equity capital structure of the subsidiary is determined as DAOs. NCI share, percentage online share held times profit for the year, that is profit after tax of the subsidiary. The share of NCI where there is preference shares within the equity capital structure of the subsidiary can be determined under the following scenarios. Where preference shares, where preference shares are held entirely by parent company, NCI share is equals to percentage online share held times profit for the year of the subsidiary minus, okay, I'll take it again. Where preference shares are held entirely by parent company, NCI shares is equals to percentage online shares held times bracket open profit for the year of the subsidiary minus preference dividend. 2, where preference shares are held entirely by the non-controlling interests, NCI share is equals to percentage online share held times bracket open profit for the year of the subsidiary minus preference dividend plus preference dividend. Then the next one, where preference shares are held partly by the parent company and non-controlling interests, NCI share is equals to percentage ordinary shares held times bracket open profit for the year of the subsidiary minus preference dividend bracket close plus percentage preference share held times preference dividend. I think that was all. Hello?
Thank you very much. Now let's look at it from this perspective. Preference shares, is it equity? Is it liability? Let's start from that perspective. What is your answer?
I think we've discussed that, and we came to the realization that preference shares, depending on the categorization, it could either be a liability or it could be an equity. If it is irredeemable preference shares and irredeemable and non-cumulative, if those two factors are present, then it becomes equity. But if it is redeemable and it is cumulative, then it is liability.
Okay, I think what you are saying is very simple, that preference share is hybrid in nature, that could take a form of equity or a form of financial liability. And that is only equity if such preference shares are irredeemable and non-cumulative. But it is a liability if it's redeemable or if it's irredeemable but cumulative in nature. Is that what you have said?
Yeah, I think that's what I was trying to say.
Okay, thank you. Now, what is the implication if preference share is a liability? What is the implication in the statement of profit or loss and statement of changes in equity? What's the implication as opposed to if it is equity?
Okay, the implication is that if it's a liability, then it is if it's a liability, then it's a liability. I don't know. You categorize that part of the liability.
What impact is your classification of preference shares as a liability? What impact does it have on your statement of profit or loss, and rather also on your statement of changes in equity?
Okay, in profit or loss, if it's a liability, then you probably recognize another cost, which is interest cost paid to preference shareholders. I think that is how it's going to affect your statement of profit and loss. Then that is for that. Then in terms of your statement of changes in equity, if it's an equity, it will form part of the parent equity, the part of the retained earning, their interest.
Okay, who else?
So just to support what Enauru had said, if it's liability, the preference dividend will affect the income statement, and it will flow into the retained earnings, which will also be reflected in the statement of changes in equity. But if preference share is equity, I think it will only affect the statement of changes in equity as other equity items that affects the financial statement.
Who else? Huh?
The fund.
And we can't hear you. You are muted.
Yeah. Hey, you skip.
Okay, Nuruddin.
I think I'm in line with what Enauru and Segons have already said. And my submission too is that if preference share is a liability, it will affect the statement of profit or loss by being a finance cost or interest cost, like an hour said. It will also flow to changes in equity. And as if preference share is treated as equity, it will only affect changes in equity in form of the equity capital.
Okay, now I think you guys have done justice to that. If preference shares is treated as liability, the dividend paid to it will be treated as an interest cost or a finance cost, and which will be deducted like any other interest on loan before arriving at the profit for the year. But if it's treated as equity, such dividend will be treated as a distribution rather than as an expense. And that will be treated within the statement of changes in equity, similar to how we treat ordinary dividend by way of deducting it from retained what? Earnings. Okay, and that is that. Now, I just try to refresh our memory about that, as that may have effect on our treatment of preference dividend within group accounts. Okay, that's what we need to do now. And we are going to attempt solving that question with this practical question. Who will read for us?
Okay, let me read. Illustration 2023. So I read. Arsenal acquired 80% interest in the equity of Chelsea as at January 1st, 2014, when the retained earnings stood at 20 million. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. We have Arsenal, then we have Chelsea, everything in thousands. We have revenue for Arsenal 600,000, Chelsea 390,000. The cost of sales, Arsenal 345,000, Chelsea 201,000. Then we have distribution costs, 45,000 for Arsenal, 45,000 for Chelsea. Then we have admin expenses, 107 for Arsenal, 90,000 for Chelsea. We have dividend income, 2,000 for Arsenal, nil for Chelsea. We have income tax, 25,000 for Arsenal, 29,000 for Chelsea. And then we have movement in reserve, retained profit brought forward, 120,000 for Arsenal, 67,000 for Chelsea. Profit for the year, 50,000 for Arsenal, 25,000 for Chelsea. Dividend paid, ordinary shareholders, we have 10,000 for Chelsea, nil for 10,000 for Arsenal, nil for Chelsea. Then from preference shareholders, nil for Arsenal, and then 2,000 for Chelsea. Then we have retaining carry forward, 160,000 for Arsenal, 90,000 for Chelsea. Required. Prepare the consolidated profit or loss and the consolidated statement of changes in equity. Given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million. Within the equity capital structure of the subsidiary, the parent held all of its preference shares as at the reporting date. In this context, of this text, we approach. Oh, sorry, I think I'm done. Should I continue?
Yeah, that's all. Now,
Okay.
if you go back here, all what you have here is just to summarize some things. It's not necessary as we go on. You find out that there are principles that you understand based on the explanations I've made. And that's why I always tell people that I'm not much more skewed towards formulas, having format and some other things. No, because I'm much more focused on trying to disseminate principles. Your better understanding and appreciation of the principle will always make you to solve as many problems as you encounter in life. Okay, and therefore we will not necessarily focus on all of this because they are not necessary at the end of the day as you see it. But now let me share my screen with respect to information given to us. And I don't think anything has changed in this information. Okay, nothing has changed, I guess so. Now the only factor here is just at this point here. Okay, what's going on? Okay, let me just use this right. It's just this point. This is what is new to us. Preference dividend. How do we treat this preference dividend at the end of the day? Okay, in this question, we are told that the all preference shares of the subsidiary is held by the parent, which means 100% of the preference shares of the subsidiary is in the hands of the parent. What then do we do? Is for us to eliminate it. Therefore, since this is explained to us, we try to eliminate the preference dividend. Now, how do we do that? We come here to say preference dividend held by the parent in the subsidiary have to be eliminated as thus. Now, how do we do that? Now we ask ourselves, what is the preference dividend paid or declared by the subsidiary? I don't know what's wrong with this. Okay. I'll come back to that. I don't know what is wrong with my system. Okay. How much is the dividend? 2 million. All figures in thousands. What is the stake of the parent in preference shares classified as equity? In this case, it's 100%. Stake of others, which can be classified as non-controlling what? Interest in preference shares of the subsidiary. That will be different between 100% and what that is, which is 0% in this case. If it's 80% here, this will be 20. If it's 90, it will be 10. If this is 0, this will be 100. Okay? Now, therefore, the portion we are eliminating intercompany dividend, which in this case is preference shares. Since that is the only one declared by the subsidiary in this case, will be for us to debit the income. If you remember, we did something similar to that in, that was question 4, I guess. If you go back to question 4, dividend, yeah, this is it. Okay, what was the entry we passed to eliminate that? Remember, this was the entry, which I can just copy and paste. I'll bring it back to question 23. Now it will exceed what I have there. Okay, let me just put it here. Okay. Okay, I want to fuse it here. Now, what is information I'm going to put here? Within the consolidated statement of changes equity as at this date, what will be accounted for as dividend deduction from consolidated retained will be solely of the dividend paid by the parent, while the non-controlling guy. Likewise, the preference dividends as paid by the subsidiary will be reduced by the portion paid to the parent by way of elimination of intercompany transaction in the year. Why any amount left is attributable to the non-controlling interest, if any. In this case, the entire 2 million is paid to the parent since it's owed 100% of the preference shares of the subsidiary, which means we are eliminating the entire amount. Okay. Therefore, the entire 2 million, which is 100% of 2 million, eliminated. And that is that. Now we'll come back here. If you come back here, you can see that there's 2 million here, which speaks to that 2 million that we just analyzed. Therefore, that 2 million have to be eliminated in this regard. Now we have 2 million, yeah, and we have a 0 here. Okay, that's how we got this, and this is 107, not 105. Okay, that is that. Now, the only adjustment we are making is for dividend income, which is attributable to the preference share from our analysis here. Because of the entire 2 million paid there, the whole 100% comes here. Now, what then do we do? It's for us to deduct that 2 million as you're required to do that here, which is this elimination that has taken place. And this triggers an adjustment. Yeah. And what is the adjustment? The adjustment is for dividend, preference dividend income. Which was eliminated. And the elimination affects the parent alone because it's a portion of the parent that has been eliminated. And that is this 2 million. Invariably, what we have okay. Any question on that? And therefore, the 73 million is split between 63, 68, and 5 million. And that is what we find out here. Now, at the end of the day, the dividend income, even though I'm going to show it here, we have to be eliminated. It will be eliminated to the portion that is intercompany. Anyone that is not intercompany will be left there. Person that is a balance there. Okay. And that is it. Any question? That is how we eliminate preference dividend, but in this case, all of it is eliminated because the whole of the preference shares of the subsidiary is held by the parents. Now, let us now look at another situation where not all of the preference shares in the subsidiary is held by the parents. Can somebody look at this for us? Who can read this for us?
Okay, should I start from the beginning or should I just start from required?
No, from the beginning. Every information is relevant here.
All right, illustration 24. Arsenal acquired 80% interest in the equity of Chelsea as at January 1st, 2014, when the retained earnings stood at 20 million. Income statement for the year ended 31st December 2016. Revenue for Arsenal 600 million, Chelsea 390 million. Cost of sales 345 million, Chelsea 201 million. Distribution cost for Arsenal 75 million, Chelsea 45 million. Administrative expenses for Arsenal 105 million, Chelsea 90 million. Profit before tax for Arsenal 75 million, Chelsea 54 million. Income tax for Arsenal 25 million, Chelsea 29 million. Profit for the year for Arsenal 50 million, Chelsea 25 million. Movement in reserves. Retained profit brought forward for Arsenal 120 million, Chelsea 67 million. Profit for the year for Arsenal 50 million, Chelsea 25 million. Dividend paid to ordinary shareholder 12 million for Arsenal and none for Chelsea. Preference dividend, Arsenal nil, Chelsea 2 million. Retained profit carried forward 158 million for Arsenal, Chelsea 90 million. Required. Prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira. And the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. Within the equity capital structure of the subsidiary, its preference shares are all held by parties other than the parent as at the reporting date.
Okay. Who can analyze that question and tell us what is different from this particular question as against what we solved? And how do we go ahead in attempting to solve the problem?
So question, the percentage stake of the Arsenal in Chelsea here is 80%. The previous one, it was 100%. Sorry. I think that was happened at that time because I understand that one. I think this one is 80%. So the preference shares in this case now will definitely affect both shares and the parents. So basically, when we deduct, we are not going to deduct 2 million from the profit of the parent, or we only deduct 80% of the preference dividend from the parent profit. Then the 20% will be deducted from the profit of the NCI, because that preference dividend is going to be an adjustment that will be deducted from the group profit. That's my understanding of that question.
Who else?
Okay, if I can just try to say something based on the last sentence there, that's the preference. Please, can you show us the question again? Okay, within the equity capital structure of the subsidiary, its preference shares are all held by parties other than the parent as at the reporting dates, and that tells us that the preference dividend belongs only to the NCI and none belongs to the parents. So the usual elimination will not happen in this instance.
Why will it not happen? Because the parent add is 0%.
Yes.
And 0% in that case is zero. Have you?
Yes, sir.
Yeah. Therefore, what will happen? I will now have to change my expression here to say within the consolidated statement of changes in equity as at 31st December 2016, What will be accounted for as dividend deduction from consolidated retained earnings will be solely of the dividend paid by the parent, while non-controlling interest will be reduced by the portion of dividend paid to it by the subsidiary, as shown below. Likewise, preference dividend as paid by the subsidiary will be reduced by the portion paid to the parent. But in this case, it won't be reduced. Likewise, the dividend paid by the subsidiary to the NCI paid by the subsidiary to the NCI, which is 2 million, will be deducted against the NCI that's not controlling interest within the consolidated statements of changes in what? Equity. Therefore, nothing to be eliminated in that case. Now, what will I do? I come here. You can see that this is automatically 0 because it's 0%, and therefore no elimination here. Therefore, we come to our statement of changes in equity. We now have to show the amount of dividend preference. There are 2 dividends there. Preference dividend and ordinary dividend. Now, the parent has dividend of 12 million. That will come under the retained earnings. And under preference dividend, the entire 2 million will come here. Because here the parent is 0%, and this is 100 what? %. Therefore, okay. Therefore, what is our position here? Okay. Okay. Now that's how we treated the preference and ordinary what? Dividend. Okay. Now you have seen the 2 extremes. When all of the preference share is held by the parent and when all of preference shares are held by the subsidiary, by the
NCI.
NCI or others as the case may be. Now, let's now see in between, where partly parent and partly NCI. Again, let's look at the solution again. This is the solution. You can see that there was no elimination of the interest, the preference dividend. Okay, the only treatment you have accorded it is to deduct everything against the non-controlling what? Interest, as the case may be. Okay, now let's now shift to the last exercise. This is the last exercise. Can somebody read it up?
Okay, so illustration 25. Arsenal acquired 80% interest in the equity of Chelsea as at 1st of January 2014, when the retained earnings stood at 20 million naira. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at 31st December 2016. Income statement for the year ended 31st December 2016. Revenue for Arsenal 600 million, Chelsea 390 million. Cost of sales, Arsenal 345 million, Chelsea 201 million. Gross profit 255 million for Arsenal, 189 million for Chelsea. Distribution cost, Arsenal 75 million, Chelsea 45 million. Administrative expenses 107 million for Arsenal, 90 million for Chelsea. Dividend income is 2 million for Arsenal and nil for Chelsea. Profit before tax 75 million for Arsenal, 54 million for Chelsea. Income tax expense 25 million for Arsenal, 29 million for Chelsea. Profit for the year 50 million for Arsenal, 25 million for Chelsea. Movement in reserves. Retained profit brought forward 120 million for Arsenal, 67 million for Chelsea. Profit for the year 50 million for Arsenal, 25 million for Chelsea. Dividend paid to ordinary shareholders 10 million for Arsenal, nil for Chelsea. Preference dividend nil for Arsenal, 2 million for Chelsea. Retained profit carried forward 160 million for Arsenal and 90 million for Chelsea. Required. Prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. Within the equity capital structure of the subsidiary, the parent holds 40% stake in the preference share capital, while the balance is held by parties other than the parent as at the reporting date.
Thank you very much. Now, who can tell me the uniqueness of this question compared to others? The other two.
Okay, so the only difference is because of the preference share capital are owned by both the parent and the NCI or others, as it is referred to in this question. So 40% belongs to the parents, while the NCI owns 60%.
The stake of the parent, in this case, the stake of the parent in this case is 40%, which then means that the parent will be 40%, NCI automatically will be 60%, which means what we're eliminating is just 800. 800 million, sorry, 800,000, which represent 40% of the 2 million. Is that not? The balance is amounts in which NCI will be deducted. And therefore, that comes to this narrative here that says, within the consolidated statement of changes in equity, as at 31st December 2016, what will be accounted for as dividend deduction from the consolidated retained earnings will be solely of the dividend paid by the parent, while the non-controlling interest will be reduced by the portion of dividend paid to it by the subsidiary as shown below. Likewise, the preference dividend as paid by the subsidiary will be reduced by the portion paid to the parent by way of elimination. Portion paid to the parent in this case is 800,000. That is 40% of 2 million. Okay, by way of elimination of intercompany transaction in the year, why not any now? Why the amount left, which in this case is 1.2 million, that is 60% of the 2 million, is attributable to non-controlling interest. And in that case, in this case, only 800,000 will ultimately be eliminated and 1.2 million deducted from the amount of the non-controlling interest within the consolidated statement of changes in equity. Okay, that is a phrase there that I've built in. Any question on that? Any question on that? Any question?
So I'll look at it that what if you said the 800,000 of the preference dividend that was paid to the parent will be eliminated in the consolidated, whereas the 1.2 that was paid to the NCR will be eliminated within the statement of comprehensive statement of changes in equity. But would it make any difference if both of them, the 800 and the 1.2, are both eliminated in the consolidation, because you still give us the same balance?
And the first question you ask yourself is that the parent only accounts for dividend income that he has received everywhere else in his own books. It's not accounting for others. Therefore, how will you eliminate others within the profit or loss of the group when that amount was not even recorded within the group in the first case? Remember, this is the parent account. In the parent account, every dividend income here is from all of his investments. In the subsidiaries account, dividend paid is not an expense. It's within the statement of changes in equity. which you have consolidated with the parent. And at that point is where you separate NCI from it. And from that point, what do you do? Every deduction against NCI is within the NCI account. And where's NCI account is just this singular account here, you can see here. Does that make sense to you?
Okay. Okay.
Okay, which means the portion that is uneliminated in the group account here, which is 1.2 million, will be attributable to other investments other than subsidiary or associates. Okay. Any other question? That is that. Any other question?
Come, why you using this rub me now? What is wrong with you people now? Mama, I will flow.
Any other question?
Yeah, Mr. Samuel.
Yes.
Hello, preference dividend. Ordinary dividends, I think it will maintain 10,000 instead of putting it for 12,000. Because
how much was in the question? Okay, it's 10,000, sorry.
From the question, we have
No, it's
10,000 and there is.
Yeah. It's 10,000, not that. Okay? Is that okay?
Very okay.
Any other question? Any other question? Any other question? Okay, because that means at this level, we are bringing into a closure our discussion with reference to consolidated statement of profit or loss and other comprehensive income, and likewise, consolidated statement of changes in equity. We'll be venturing into the last discussion within this arena, which will be on accounting for your investment in associate and your interest in joint venture. And also with respect to requirement of IFRS 11 on joint arrangements. Any question at this point? Okay. Again, what we only eliminated is 800. And that is from the perspective of the parents and not of others, which you need to take note of. Any other question, please? Any other question, please? This is 67, and that information. Okay, in the absence of none, this session with respect to consolidated statement of profit or loss and other comprehensive income will be brought to a close. Likewise, the consolidated statement of changes in equity. Okay, we'll go on recess, and in our next session, which will start from 1:20, we'll venture into discussion with respect to investment in associate and joint venture and discussion on IFRS 11 with respect to joint arrangement. Thank you very much, and God bless you guys.